Hey guys, I'm the Newb investor. Today we'll be looking at the 5 biggest tech companies that actually makes money in the US today. Apple, Microsoft, Google, Amazon, and Facebook. In the previous videos, we looked into them individually, but now we'll be looking at them side by side using my 3 metrics. My first metric is the EPS multiple. It should be less than 3. I'm sure you've seen this in my previous videos where I divide the current PE by the EPS trailing 12 months. This measures how much we're paying the stock on the basis of the current earnings. The lesser the multiple, the better. But I am allowing a multiple of 3 times earnings just to screen the stocks. This is what I use mostly to screen stocks because it is almost readily available to most sites out there. You can compute EPS trailing 12 months in TradingView. You can see PE when you search for a stock in Google. Also, my next metrics require looking into their financials, so I have to use a tool to screen them before going into their financials. These metrics tell me whether the company is earning enough or whether they're buying back shares. My second metric is this. I know you might not understand, but what this means really is whether we're buying the stock at an overvalued, fair, or discount prices. We want to pay a stock $1 or less for 1% of the money they're making. It just makes sense to pay $1 for $1. But if you can buy $1 for less than $1, well, that's a screaming discount. Now hold on, I know this is a lot to take in, but I will explain how useful this is. My third metric is to simply look at historical PE. So basically, I'm taking the average PE where the stock has traded within the bounds of consolidation. From there, we'd see how the stock was valued then and how the stock is trading now. Of course, we want all those fundamental metrics like revenue growth, share buyback, etc. But to me, this is what matters, the price we're paying for a stock. I promise to make sense of all these metrics later, so hold on tight. When I'm buying a stock, I don't necessarily look at the price, but I look at the PE ratio because that's what we're paying for in the stock, really. So my metrics are pretty heavy on the PE. On the left, we'll see the current market situation of the stocks. On the right is the list of what we'll be doing. We'll be ranking them from a buy standpoint on the basis of the metrics we use. We'll determine either we're paying for a stock that is overvalued, trading at fair values, or at a discount. And also, I will share with you my target entry for the stocks and I will explain why. This is revenue growth, the father of all metrics. The metrics where all other metrics revolve around. Every investor wants a growth in revenue because most of their models only account for growth, not for a loss in revenue. We want their revenues to either stabilize or grow, but not lose. You'd rarely see any value investors who would assume a loss of revenue. Anyhow, on the left side is their respective revenues from 2019 to 2021. The values are in billions. We can see that all 5 of the company's revenues have all increased from 3 years. On the right side, we'll see the growth from 1 year, 5 year, and 10 years. We can see here Facebook has essentially 30x their revenues from 2011. Would any investors project a 30 times in revenue in 10 years on their models? Next month is income growth. Of course, net income grows along with revenue growth. On the left side, we'll see that every company has increased their income in the last 3 years. On the right side, the income growth from 1 year, 5 year, and 10 year. Now, take note that the number you see here is not in compounded form to avoid confusion. As investors, we want to be rewarded. Some companies give out dividends, others don't. But the most important thing is them buying back shares. We can see here, all of them except Amazon bought back shares in 3 years time frame. We want to invest in companies who are essentially debt-free in 5 to 10 years, meaning they can pay their long-term debt in 10-year horizon. On the left, we can see that only Microsoft has been paying their debts for the last 3 years. Others, their debts are increasing. But it's not bad to borrow money. What's bad is if you can't pay. On the right, we'll see that with their cash and free cash flow in 2021, they can easily pay all their debts in the span of 10 years. Now, this is where my metrics come in. First, we have to deconstruct the revenue into components. COGS, operating expenses, and net income. COGS is the cost of goods sold or cost of revenue. This is what costs them to make the revenue. OE or OPEX here is operating expenses. Things like SG&A and R&D. And sometimes unusual expenses are priced in here. Net income is basically the money they make after the costs and taxes. Net income here is after tax. What you see here is in percent revenue. Meaning, let's take Apple for example. For a revenue of 365.82 billion in 2021, 58% of that goes to COGS, 12% goes to OPEX, and 26% is their net income. In numbers, 212.98 billion of 365.82 billion is spent on COGS. 43.9 billion is their operating expenses, and 94.67 billion is their net income for 2021. We can see here that Apple and Amazon spends a lot on COGS compared to software-based companies who spends less on COGS and makes more net income relative to their revenues. FB tops net income relative to revenue next to Microsoft in 2021. Now, we do this for 1 year and take the averages for 5 years and 10 years. In the case of my metrics, we'll only use net income. I box the net income from 1 year, 5 years, and 10 years. We do the same thing for free cash flow. Free cash flow is derived from net income plus or minus some expenses. FCF is operating cash flow less capital expenditures, CAPEX. I explained this in my last video on how to calculate for FCF in Yahoo Finance and Macro Trends. You might want to check them out. In 2021, among the 5 companies, Microsoft made the most money of their revenues. Next is FB. Amazon has negative because they have high capex. They've been spending a lot to improve their business. We take the 1 year and the averages of 5 year and 10 years, so you can see it here on the right side. Remember, the values here is in percentage of their revenue. This is my first and second metric. First metric is this far right here, the EPS multiple. If we divide the current PE ratio by the EPS trailing 12 months, we'd get this multiple. Google and Amazon has low multiple because their earnings are high compared to numbers of shares standing. A stock split or them issuing more shares would solve this. Apple and Microsoft have very high multiples. Remember that we want it lower than 3. It means for the current outstanding shares, their earnings are relatively small. What they want to do is either buy back more shares or increase their net income, which is kind of harder to manipulate. My second metric is taking the lowest value of the 1 year, 5 year, and 10 year averages of both net income and free cash flow relative to revenue. As you can see, I boxed the lowest value we came up with. We choose the lowest value here because that would be the starting point of our assumptions. Then we divide this by the current PE so we can see whether the stock is trading at an overvalued, fair, or discount prices. As you can see, FB trades at a discount while Google trades around fair value. I wouldn't say Apple and Microsoft are trading at fair values because 1.2 times is overvalued already, let alone the 19.25x of Amazon. Now, I want you to remember that my second metric does not account for the values of the revenue. If the company reports a loss in revenue, say the sales drop 50%, obviously the values of the net income or free cash flow would drop 50% as well. But the percentages of net income or free cash flow relative to revenue stays the same or would still be around the average. This could drastically change when fundamentals of the company changes, like acquisitions, write-offs, and spin-offs. Now, to my third metric, we'll be looking at the historical PEs where the PE trades in a range of consolidation and take the average from then and we'll get our historical average PE. I'll be showing you the PE where this stocks traded. We have here Apple, Microsoft, Google, Amazon, and Facebook. If you look at the midsection, you'll see the number of quarters and the years I took the PE from. You can see here the lows and the highs and the average, which is the most important. Now, we'll use it to divide the current PE to determine how the stock is valued now by the market. We can say that Google, Amazon, and Facebook is now below the PE traded before, while Apple and Microsoft are valued more than before. This metric does not take into account what had happened then, why the stock was not valued much compared to now. Now, if we combine the three metrics, Amazon, Apple, and Microsoft are not the stocks to buy from these metrics. Doesn't mean you don't have to buy, but what the metrics tell us is that there are better buys like Facebook and Google. Now, it also doesn't mean it can trade any lower. As you saw from the historical PE, remember that the price is dictated by the buyers and sellers' behavior of how they value the stocks. On the right side are my entry PEs. I've included there the discount of risk and rate of return, assuming their EPS won't change. To conclude, it makes sense to pay premium for FB and Microsoft because they generate more money relative to their respective revenues, but take into account the risk involving the stocks. The better buys right now are Facebook and Google, but I'd buy Google more than Facebook as FB poses more risks compared to the other stocks. These are my entry prices on the stocks. I might change my mind, but I'd still be paying around those prices.